Thank you, and welcome everyone to this week's speaker series over here at Insignia. I'm happy to be joined today by Steve Shigekawa. Steve, thank you for joining us.
Thanks for having me.
So Steve is the senior portfolio manager on Neuberger Berman's U.S. Real Estate Securities Fund. This is a fund that we know well. We actually have it in some of our strategies that we manage at the CIO level. So, Steve, it's a pleasure to have you here, and going to be an interesting conversation with you. Especially, we've seen some surprises out of the U.S. Real estate market lately here. Why don't we start off with perhaps some commentary on that, in the sense that I think most of the surprises, or a good chunk of the surprises we've seen on the economic side, in the economic data in the U.S., has been coming out of the real estate market. And I think it's caught many people by surprise. I'll throw a general question here to you, but I'll let you take this in whatever direction you want. Have we not yet felt the effects of the rate increases in the real estate market, or are the supply-demand imbalances such that the rate hikes don't matter all that much? So let's start there.
Sure. Obviously, I think the news of last year was the beginning of tightening by the Federal Reserve. I would say that it is impacting real estate. Obviously, real estate is an asset class that uses financial leverage, and the debt costs are significantly higher than they were a year ago. But in terms of real estate fundamentals, they've continued to hold up pretty well. I think concerns around recession continue to be pushed further out with solid employment numbers. But I think there is that concern that it may get a little bumpy moving forward. It was a challenging market for REITs last year. They were down about 25%. And I think it's reflective of sort of what we were seeing on the macro side, higher borrowing costs, concerns about a potential recession, and focusing on inflation. We also saw, earlier this year, kind of the regional bank problems in the market. Late last year, there was some headlines around the non-traded market, where you were seeing redemptions starting to build in terms of private non-traded REITs. Mm-hmm. But I think it really sort of highlighted that the public market, because of its access to daily liquidity, is going to see the effects of some of the changes from the macro environment faster than you'll see in the private market. And so it's created this opportunity where we think that the public market is priced at a discount to where you're seeing private market assets. And so I think that there's opportunities going forward. The Fed has done 10 rate increases over the past, call it 15 months. I think market expectations may be one or two more 25 basis point moves, but the rate increases appear to be largely behind us. And historically, that's been a good time for the publicly traded REIT market. So we're optimistic as we allocate our portfolio. There are sectors that are challenged. I think people are reading headlines about the office market, and so are concerned about that sector. But there are other sectors where fundamentals continue to be very strong.
Okay, and we can maybe dive into those in just a few minutes, but I kind of want to get back a little bit to sort of or stay on the macro picture. For a very long time here in this country, we didn't build enough homes. We certainly didn't build enough homes for the demographics, the immigration, the general population growth, and the urbanization here in this country. Is that you think that the biggest factor behind the resiliency that we're seeing in U.S. real estate prices? I mean, I'll make a quick anecdote here. So we did a survey of what the street was sort of thinking at the beginning of the year. And I think most Wall Street analysts had prices falling anywhere from 10 to 15%. Those are sort of the estimates we saw. We internally here in Insignia, we were a bit more sanguine on that. We thought prices would fall somewhere between 5 and 10. So we were definitely on the lower end of that range. But we're seeing that on an aggregate level. Actually, home prices are pretty flat for the year.
Yeah.
Of course, there's differences in certain markets, and we can get into that because I'm sure that sort of goes into your investment strategy. But to what do you attribute that strength and that resiliency in U.S. home prices, despite like what you mentioned, 10 rate increases in 15 months? It's really been the most extraordinary tightening cycle that we've seen in at least in any of our lifetimes, people that are invested. So maybe just a few comments on that.
Sure. I think your first comment was exactly right. If you go back to the global financial crisis, really started with problems in the U.S. housing market. And so it's been, 10 or 15 years of underbuilding of homes in the United States. And so we think that there's a shortage of homes, especially on the affordable end of the market. But I think the forecast as it relates to home prices was really related to the mortgage market. You could do a 30-year mortgage 15 months ago, sub 3%, and today it's probably closer to 7%.
Right.
And so the natural view would mean that home prices would likely fall. But the resiliency has really shown up because there's just a shortage of homes. Existing home sales, or the transaction market for existing homes, has really slowed. And it really makes sense. If you're a homeowner and you are thinking about moving and you have a sub 3% 30-year mortgage, you are less likely to want to sell that home in the short term, because any new home that you buy, you would have to have a much higher mortgage on that. And so there's really been a shortage of transactions in the existing home market. The new home market has held up because the builders have incentivized. They've been paying down mortgage rates for new buyers, and there continues to be a good employment market. Employment continues to be strong, and so there is that demand. But I think the market, the initial shock of a 6 or 7% mortgage was really where all of those forecasts for home price declines came from. But I think as we start to, if we see weakness in the jobs market, or we start to see, transactions pick up in the existing home market, it's likely that you'll see a little bit softer prices on the existing side, just given the backdrop of the mortgage market. Within our investment strategy, we're trying to take advantage of this dislocation in the housing market, and we own residential rental properties. So it's apartments, manufactured homes, and single family rentals, and they've held up. They've actually done very well so far this year.
Okay, so Steve, you mentioned earlier, which is absolutely true, that usually when we're at or very near the end of tightening cycles, it's usually a good time to sort of deploy assets into the public REITs market. The pushback to that would be, well, because over the last several decades, every time we've been near the end of the tightening cycle, we've also been in the imminent beginning, let's say, of an easing cycle. Right now, the market's not expecting that. The market has pushed out the expectations for Fed rate cuts well into 2024, much more hawkish than where they were even a few months ago. Does that change at all your expectation for how you think your fund specifically, or the broader real estate market, could potentially do here over the next few months?
Well, obviously the market was challenged last year. So, we have seen a pretty significant drawdown in the public REIT market. And so valuations are more attractive than they were, 15 months ago. But I think the concern, or some cause of concern, is the potential for a recession. And I think in a recessionary environment, we want to make sure that our portfolio is positioned accordingly. We can invest in over 15 different property types. So we're underweight cyclical sectors like the lodging space. We have underweight, our largest underweight is to the office sector. And we have overweights to sectors that we think will continue to generate strong cash flow growth, even in a modest inflationary environment with that potential economic slowdown. And so really what we're able to do is position the portfolio, to take advantage. And I think one point worth I think reminding investors is it's very difficult to pick peaks and troughs
It's impossible.
in terms of going in and out of the market. So we want to be positioned what we're seeing today and what our expectations are going forward. If you go back to the financial crisis, obviously the worst part of that was the fourth quarter of 2008 with the Lehman bankruptcy. But in 2009, REITs were up 28%. And I would say if you were sitting at the beginning of 2009, while it felt like a recession was here, it probably wasn't showing up in the economic data. But obviously we were in a recession triggered by that that difficult 2008. But 2009 and 2010, when we were in and exiting a recession, REITs actually performed very well in both 2009 and 2010.
So your portfolio, specifically the Neuberger Berman U.S. Real Estate Fund, so that's been around for over 10 years. So it's been around for quite a while, but it hasn't been around the last time we had a sort of stagflationary environment. And I'm not saying that we're necessarily going into one, but it could potentially feel a lot more like that. Back then, we're talking about really the period from 1973 to 1983, roughly. We saw real estate was one of the best performing asset classes during that period. And I think a lot of investors sort of expecting that stagflationary type environment were like, well, listen, let's load up on real estate because it's going to be a buffer in an environment where inflation is structurally higher than it's been over the last 20, 30 years. And many of them were caught off guard, like you said, last year, because last year the public REIT market was down 25%. What do you attribute that disconnect? Were they early to the trade? Are the dynamics different this time around? Or do you expect that in a structurally higher inflationary environment, real estate will continue to give you the sort of inflation adjusted returns and protections on income that other assets like fixed income cannot?
Yeah, we've done a lot of work on that. And I think when we were talking to investors last year, the question was, well, real estate has typically been a hedge to inflation, and yet REITs were down 25%. I think the down 25% was more a reaction to interest rates being up dramatically over the course of last year. When you look at, and we've done a lot of work on this, is looking at how do you get that inflation hedge by investing in real estate, and how does it differ from fixed income? And what we try to do is we're looking at real estate and income generation. So if your cash flows are not growing in excess of inflation, you won't have an inflation hedge. And so we're able to position the portfolio in sectors where we think cash flows are going to grow 2 to 3 times the rate of inflation over the next 2 years. And that's where you can get an inflation hedge. And so in an inflationary environment, you want to be in those sectors where your cash flows are going to be protected from that inflationary pressure. In terms of a stagflation type environment, obviously that's a challenging environment for many assets. But real estate, we're able to position the portfolio into different economic periods. So if we want to be, if it's an economic slowdown, we would be very defensive. We could have bigger weightings in the healthcare sector. We could have bigger weightings in assets where you have very long-term leases that are where your cash flows are protected, versus a more cyclical time period where markets are moving up rapidly. You would be positioned in sectors like the hotel sector, or ones where cash flows would benefit from an improving economy. But in a slowing economy, you would want to be in real estate where the cash flows are going to protect you from that slowing economy at the same time as it's giving you that inflationary hedge. And so obviously it's a difficult needle to thread, but we in the public market, we can invest in so many different types of properties. And I think that's one of the benefits. If you look at the private market for real estate, most people think of office buildings, retail, apartments, and industrial assets. In the public market, that's 60% of the public market is outside of those sectors. And so we can invest in storage facilities, healthcare, cell towers, timberland, data centers, and a wide range of different areas of economic exposure. And so I think that's the benefit of the public market versus a direct investment in real estate, because it tends to be in sectors like malls or office buildings where you're seeing more challenged fundamentals.
Okay. And I'd like to remind everyone that if you do have questions for Steve, you can submit them either to the chat directly here on the webinar, or you can submit them to me directly. I'd be happy to sound those off to him in just a minute here. So Steve, let's dive into your portfolio right now, how you're currently constituted. Give us some highlights. You sort of mentioned it, but let's sort of put it together here. Where are your overweights? Where are you underweight? And what's your expectation for the rest of the year for how you're presently constituted?
Sure. Our largest overweight is to the self-storage sector. It's one where we think we're going to get mid-teens type cash flow growth. We have a very low vacancy rates in the self-storage sector. As I mentioned, we're overweight residential sectors, so single-family rentals, manufactured homes, apartments. We're also overweight cell towers. We think that even in a recessionary environment, that cell tower fundamentals will continue to be strong. I think we all, in terms of discretionary or non-discretionary spending, I think people, think about their cell phones as vital to maybe even more important than their rent in terms of the importance of having a cell phone. And so with 5G technology, all of this talk about autonomous vehicles and artificial intelligence, Internet of Things, those are all things that will thrive in a 5G environment. And so cell towers is a sector that it's actually been underperforming so far this year, but we think the resiliency and strength of those underlying fundamentals will benefit the portfolio. In terms of underweights, our largest underweight is to the office sector. I think we understand the headlines of work from home and people being in the office, in a hybrid environment, let's say 3 days a week. It just means that you're going to see less demand for office longer term. We see that in terms of utilization rates are about.
If you had to put a number in it. Sorry to interrupt you, but if you had to, because I think that's definitely I think that's sort of the intuition that's out there. If you had to put a number based on percentage of, let's say, pre-pandemic demand for office space versus post-pandemic demand for office space, what sort of fraction are we talking about here? Are we talking about 80% of the demand? Are we talking about 50? What's your sense of where that's going to lie?
We think it's going to be 15 to 20% lower demand longer term. Even though if you're in the office 3 days a week, that's what 60% utilization. But right. You do have to have an office space. I mean, even if you're only going in 3 days a week, you still need to have an office to go to. So, right. And those locations continue to be where mass transit is centered around, and where the centers of industry are. So the office buildings are ways where companies can build culture and get their employees together, whether or not they need people 5 days a week or 3 days a week. We think that they will continue to be in office buildings. But right now it's a challenging market. Many of the largest cities in the U.S. have vacancy rates that are approaching 30%.
Yeah.
And that's heading into a potential recession. So we obviously are concerned near term, but we don't think that the office building is going away. While we all work from home for 2 years, I think management teams recognize the importance of getting their employees together. Even in the technology sector, you've seen some of the big tech companies talk about getting their employees back into the office. So, but we think that just because you're in the office, your employees are in the office less, you may need less square footage per employee. And so we think that that translates to kind of in that 15 to 20% less demand moving forward.
Right. And perhaps we can talk. So you have a big underweight in office. Any other major underweights of note too that you want to bring up?
Sure. We're underweight the lodging space. I think going through COVID, we all knew that no one was traveling for a year, and then there was pent-up demand, and then everyone wanted to travel coming out of COVID. But we're starting to see that normalize, where leisure travel patterns are starting to normalize. Consumers are starting to push back at rates for airfare and for hotels. And I think the business travel is also going to be impacted because of events like what we're doing right now, is that instead of being in person and meeting with clients in person, that oftentimes a Zoom call or webinar can be a good alternative. And so if you think about the road warriors that used to be on the road all the time, some of those meetings are now going to be virtual. And so we think that business travel trends will be softer than they have been in previous cycles. And so and just the cyclical nature of the lodging space. So we have zero exposure to lodging. And then we're also underweight two sectors where the fundamentals are actually pretty good, data centers and industrial warehouses. But
that's interesting. Yeah. I would like to hear what's the logic behind that underweight.
Yeah. For us, it's a valuation call. Within the data center space, there used to be 5 or 6 publicly traded data center companies. But about a year and a half ago, 3 of them were privatized. They were privatized by private equity firms. And so the pricing of data center assets was bid up in the public market. And so for us, it became a sector that we wanted to trim back. And then when there was concerns around technology and technology slowing, it made sense to us to sort of lighten up on that space. Obviously, the mega cap tech companies are doing very well on a year-to-date basis, but we just think that on a relative value basis, and given that there's only 2 data center publicly traded companies, both good companies, but we own one of them, Equinix, and we actually don't own the other one, which is Digital Realty. So that's sort of an out of consensus call for us. And then in the industrial warehouse space, we're modestly underweight that sector. It's arguably been one of the best performing sectors over the past decade. Obviously with e-commerce versus brick and mortar, companies like Amazon and demand for warehouses. Obviously at the beginning of COVID, warehouse demand was extremely strong, but valuations had gotten to 30 to 40 times earnings, and we just thought that was too high. So we've lightened up there. We still have a significant position in Prologis, which is the largest REIT, but we're modestly underweight the sector.
Okay. And I guess final question for you, Steve, is here. Maybe we can talk about some of the regional differences in the country. How much does that factor into your decision making? Obviously, we've seen massive increases in prices in places like South Florida, which is where I am, Texas, sort of the South, the Sun Belt, right? And we've seen a massive exodus out of the Northeast, out of places like Chicago, out of California. Do you think that trend is still in place, or do you think it's largely run its course and now perhaps it could be time to start looking at some deals back in places like Chicago, San Francisco that are pretty beaten up in terms of, because of the politics and all that? Just kind of reviews.
It's interesting. People have been moving from New York to Florida and from California to Texas for decades. And obviously COVID really
accelerated that.
There was a trade to be made to own the Sun Belt during COVID. We think a little bit of that will reverse. Miami's been a great market, but we are starting to look increasingly at opportunities in some of the more challenged markets. Obviously, we're still avoiding the office sector, but the coastal markets is, they've always traded at premiums, and there's a reason why so many people live in New York and so many people live in California.
Right.
But I think a little bit of the politics has kind of created even more volatility around that. But anecdotally, you're starting to hear of a pushback of people in Texas kind of saying, we've had enough of Californians moving to Texas, and that environment may not continue. But obviously, cities like Austin and Nashville and other Sunbelt markets have been very strong. But we think that the next opportunity is probably going to be looking at some of the previously and currently distressed coastal markets.
Interesting. Any sort of any metric that you use for sort of long-term appreciation in real estate? Like I've heard one of the most interesting papers I read on this subject was following human capital. That human capital clusters and centers were the best sort of predictor for real estate prices. Any kind of views, any sort of, what framework do you use to assess these sort of longer term trends?
Yeah, we're really looking for supply constrained markets, and in some cases it's geographical, because the geography makes it difficult to build. In markets like California and even in Miami and New York is, you're on the coast, and that's an appealing market for people to live and work in. And so you can look at land values, but you're looking for density of population, whether it be for demand for apartments or retail locations. We think that that's critical. Obviously, the Sunbelt markets have benefited because of the job growth that has happened in those markets. But you also have to remember that in many places in Florida and in Texas, it's very easy to build. And so they tend to be markets that have gotten overbuilt. In a market like California, the regulatory environment is very difficult. So you can't quickly add new supply in those coastal markets. And so that keeps land values high. And it's obviously areas where you have that population density. So, we look for markets where you have that population density, those clusters. Oftentimes it's around learning and education. So it could be clusters around universities. It could be industry clusters. So a market like Northern California or Seattle or Austin, where technology has chosen to cluster companies, that could impact the value for different locations. And so we're able to look at all different property types, all different locations, and see what the relative value is, and make sure that a market is trading at the appropriate premium to the national average.
Excellent, Steve. So unfortunately, we've run out of time, so we can't continue this conversation, although I could continue it for quite some time. I'll leave you with an anecdote I read the other day on Bloomberg that the Miami market, which is, like you mentioned, it's the market I'm in, it's now the least affordable housing market in the country. If you look at the median price of a home down here with the median salary, roughly 80% of that median salary would be devoted to housing. So that's also not sustainable, right? So, yeah. So I think that's a great point.
Yeah, rent to income levels, we're able to look at that and see affordability. And, you're absolutely right. There's a point where the consumer pushes back and says, this price is too high, and they may choose to live further out. So, or they may relocate altogether.
Yeah, we saw actually another article came out on Bloomberg today saying how there's actually been a net exodus from Miami itself into some of its sort of suburbs because of the unaffordability of housing, basically.
Yeah.
So,
yeah.
Excellent, Steve. Well, thank you so much. Really appreciate your time. So, Steve Shigekawa, who's the senior portfolio manager at the Neuberger Berman U.S. Real Estate Fund. Steve, thank you so much for joining us. Look forward to perhaps having this conversation again.
Okay, thanks for having me.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.